Andrew, I'm going to make you the presenter. Looking forward to saying hello to you and possibly seeing your screen and talking about your journey and what's happening in the markets nowadays. There we go.
All right. We can use this.
Okay, beautiful. Tsunami. Yeah, it definitely was, Andrew. So thank you so much for joining us. I'm certainly glad that you accepted my invitation to address our community here. And I just told people where you're at now. I like to go back to people's beginnings of their journey of how they got in the business. And I also read on your site that you majored in finance when you were a Boilermaker, not drinking them, but as a student, as a student of Purdue. So
that's right.
So you knew then, or did you know prior that you had an interest in the markets and someday we're going to be advising people on what to do with their money?
Yeah, my interest in the markets probably started when I was in high school. We did, I think it was my senior year, we did one of those kind of an economics class where you do a virtual stock trading, where you have a fake investment account. And,
yeah.
That kind of doing that kind of gave me the bug a little bit that this was pretty interesting. And I started, it was kind of a contest for our class of who could make the most money in a set period of time. And towards the last couple of weeks, I was actually managing some of the other kids in my class's fake accounts because I've been winning the entire time. So I started, I guess you could say I'd managed fake money in high school. But went to Purdue, like you said, and majored in finance, financial planning, and kind of went down that route. Worked for an RAA in Florida as an analyst there, and then I've been at my current firm for the last 6 years, working as a portfolio manager, managing our clients' assets. We manage for about 800 families, about $360 million.
Nice, congratulations.
Yeah, it's been a fun career so far.
You know what? Maybe we could start with the CMT designation certification. You know, a lot of people don't know what it is, and
sure.
And it's really not easy to get, is it? It takes some time and energy and diligence to get that.
Yeah, it's three exams. The first exam is more kind of an introductory, learn what basic technical indicators are, candlesticks and trend lines and things like that. And then the second exam is a little bit more application. And then the third exam is actually essay-based, which is a little unique compared to some of the other designations out there, other investment exams and whatnot, where they'll do different sets of questions, and then they bring all the kind of experts on each question together to review that. So if it's a question on point and figure, there's going to be one person who's an expert in industry on point and figure who's going to grade that question, and it takes them a couple months to get through it all.
Who do you remember who was the expert on point and figure?
No, they don't.
I mean, that's kind of a lost. That's a lost start. You don't. A lot of people don't do it. Go ahead.
They don't know. They don't tell us the specific people of who's grading. Probably just kind of, if you fail, you don't try to seek them out.
Right.
But it's a unique way where it's not just a standardized test, where they really do want to make sure you understand how to use it.
Okay.
Yeah.
So all right. Well, it's, you know, I'm interested. When you were writing about equity market volatility and won the Charles H. Dow Award for it, there was none. It was suppressed. We had that spike in 2015 on the Wanda valuation, and we went to 50. And it was Groundhog's Day when they finally buried all the short volatility players and spiked again to 50. Is this August 2015 all over again, or is this a different regime that we're entering where, you know, it used to be normal in the old days of having 15 to 20 vol, and the last few years people think it's normal to trade at 10. So trading here at 18 after yesterday, what did you write about when there was no volatility? What was the theme of the paper?
Yeah, it was kind of interesting. So I won the paper last spring. So it was right before we went into this environment of volatility essentially disappearing, which is kind of ironic to win an award writing about volatility, and then essentially volatility's gone. So that was a little kind of a little funny. But we really have had, what my paper's about was trying to find different methods to forecast volatility. Often people will say because volatility is really low, that's what's going to send volatility higher. Last year was a perfect example of that. That methodology really doesn't work. And so as a portfolio manager, I'm looking for ways to manage risk. Volatility obviously plays a big role in that. So I was trying to find times where, is there any commonality to these big spikes in volatility? And so this here, what I just have on my screen is a presentation I did at the University of Chicago a couple weeks ago. I'm just going to clip through some of my slides just to kind of better explain that.
My hometown. So you and I are Midwest guys.
That's right. That's right.
Yeah. Are you still in the Midwest, or
yeah, I'm still in Indianapolis.
Okay. I couldn't take the winters anymore. I left
they're
a long
tough.
time ago. Okay, so here we go. You're talking about 30% spikes. Go ahead.
So in the paper, I define kind of a spike as being a 30% move in the VIX. Obviously, it's not correct to talk about percentages moving in percentage terms, but this makes the conversation easier to have. So just I use this chart just to show that it's pretty common for us to see 30+% moves within the VIX. It doesn't just have to be black swan events. It doesn't just have to be recessions like '08. And then just looking at times where volatility dropped. So if we just look at if volatility were to move 15% lower in 3 days, that happens pretty consistently, but it doesn't necessarily always mark a low in volatility. So just saying because volatility has come down a lot, then it must mean revert higher wasn't a great indicator. So then I said, okay, what about if volatility were to close at the lowest level in 4 weeks? Saying it's been declining for 4 weeks, we had a 4-week low. That must mean that it's going to revert higher too. But what I found was that 4-week lows were often followed by additional 4-week lows and more 4-week lows and another 4-week low. That they never really marked it or were a good methodology for finding times where, okay, this is where volatility is at the highest risk of spiking.
That's a pearl. That really is a pearl, Andrew. And, doesn't that also carry through to almost any instrument? A lot of people, when things are making new 52-week lows or historic lows, have the assumption that means it's a value and it's going to turn. When I use the retail store analogy. If you go to a you go and buy something that's cheap, you bring it home and it breaks within a week or two. So buying something cheap could also mean a break coming. So
it can always become cheaper.
Right. Okay.
So looking at low volatility, I just want to see, okay, when is there any clustering of when volatility spiking higher? So I said, okay, give it 3 weeks. What's the largest increase in volatility at the different levels in the VIX? And so this shows just on the bottom axis here, you can see the different levels of the VIX and then the 3-week moves. And it's pretty diverse. You could have big spikes higher, 150% moves in 3 weeks when VIX is in single digits, all the way out to when VIX is at a 40 level. So just that wide of a gap isn't enough to tell us, okay, if VIX is at a certain level, that's what's going to send it higher. So what my paper's about was looking at the standard deviation of the VIX. So looking at the movement of volatility. And when the standard deviation gets really low, that's telling us that there's not a lot of day-to-day swings within the VIX. It's become very, very calm, which is why I titled the paper kind of Forecasting a Volatility Tsunami, meaning that oftentimes before large weather events, maybe things get very, very calm, the water gets a little placid, and then you have this giant wave that comes and crashes us.
Eye of the hurricane.
That's exactly. And so doing the same kind of scatter plot, looking at the VIX standard deviation, we can see that they all kind of cluster, that we see the biggest 3-week changes in volatility happen when the standard deviation is extremely, extremely low, meaning dispersion in the VIX is very, very low. So now I say, okay, we're on to something. At least we're getting a little bit of clustering. The biggest moves happen when the standard deviation is low. Because what this often means is that people think when standard deviation is low that the market's stable, that we're in kind of a calm period. We're not seeing markets in turmoil on CNBC, but it's a stability that actually leads to the chaos, kind of a Minsky type moment.
Okay.
So just kind of plotted just to show you previous time to all the instances, and I go into much more detail in the paper, but just to not belabor the point, that these red dots show when standard deviation gets into about a 15th percentile for the VIX. So we often see that these do end up marking major turning points within the volatility index. And just kind of click through.
Were we there were we there in February before the mini panic? And I also want to ask you what we've noticed and what I've noticed is when the market is going up and the VIX is going up too, you know, VIX is performing when it shouldn't. With the market blowing off, they're not taking it down. Is that a market tell in your volatility studies?
Well, I'll answer your first question first. So yeah, we did. I sent out a tweet on January, I think it was January 10th, saying that I thought that we're at a point where volatility risk was becoming very elevated, and that was like at VIX 9.5, and that's because while we were starting to see this very tight consolidation, along with a lot of other data that I look at, but a piece of it was this. And so the second part of your question, when volatility and the S&P are rising together, it's important to remember that the VIX is a measure of 30-day expected change within the S&P options. It's not directionally biased. So that expected change could be higher or lower. Oftentimes the VIX is negatively correlated. I think it has a long-term correlation of negative 0.8. But just because VIX is going up doesn't necessarily mean, I don't think that's a good enough predictor, because I think there's a lot of messy data within that. But earlier in our conversation, you're asking about 2015. So here's a chart of when we had the big spike in volatility. We had 3 instances where volatility got really, really low. One of which, as you can see the third circle there, where we did see standard deviation get very compressed in early August before VIX went from 12 all the way up to 50 intraday up to 50.
That was the quant evaluation. Dow came in 1,000 lower and recovered.
Yep. And so we look at the flash crash. We saw the same thing. Before the flash crash, the fat finger trade that happened in May. Back in April, we saw volatility once again got really, really compressed, giving us almost a month's heads up that we're about to see a volatility event. Look at the financial crisis. When VIX was still trading under 20 in September of 2008, we did see, just for a very brief period in early September, the standard deviation on the VIX got really, really low just before VIX went from 20 all the way up to 80. One thing that I think is really interesting to look at is the CBOE actually gave us the data to look at the VIX, even though it wasn't around during the 87 crash. They kind of back and filled to show us what the data would have been if we had a VIX. And so this is just using kind of Excel data, using the COBE's data set.
What was the number? 50 again? That magic number 50? In 87, it would have been 50?
It would have gone all the way up to 50? Yeah. So this blue line here is the VIX. It got all the way up to 50 from a low of
50, 50, 50, right? 50 there, 50 and 15, and 50 a week or so ago.
Yeah, that does seem to be kind of like the ceiling for it. But we did see standard deviation. So the red line here is standard deviation for the VIX. And so we can see right before Black Monday, before the 87 crash, we did see a very tight dispersion in volatility markets. So this just shows that there's, even before we even had the VIX, that the standard deviation, this tight dispersion, has been a very good predictor of events. So even before some black swan type events, the 9/11 terrorist attack, we did have, not necessarily right before the event, but early in the year, we did see 2 periods of low standard deviation. And so just this is kind of to wrap it up. This is the tool that I then use. It has an input of standard deviation, but along with a lot of other pieces of data that I now use for my timing of volatility. And I call it my volatility risk trigger. And this will be, I'll be rolling out a way to subscribe to this probably the next couple of weeks as a service. But this is, I think there's a lot of different information that I think goes into the way to evaluate the volatility market. And one of them, as I wrote in my paper, being standard deviation. But by itself, I don't think is a good enough timing indicator. It can kind of tell you when you're in an environment for volatility to go higher, but it doesn't give you a precise enough trigger. Go ahead.
Okay, go ahead.
No, that was my point.
So, okay, so let me ask you, when you get these readings that tell you that there's a potential volatility event coming, as a money manager, RIA, do you hedge? Do you move more to cash? How do you become defensive And do you, when you get these readings, believe in them enough to take some action with portfolios?
Sure. So being working for an RIA, I have restrictions on what I can trade. So I'm not able to go into the options market or the futures market to express an opinion. So using kind of the tools that I've been given in my toolbox, so to speak, the first thing I'm probably going to start doing is getting more risk, decreasing the amount of risk in our portfolios. So I'm more concerned with beta than alpha in that sense, where I want to increase cash. So in January, this blue dot here was January. When we did see an instance, I began raising cash in some of our more aggressive portfolios, our more equity-focused portfolios. So I was sitting closer to around 15, 16, 17% cash when we had that big move higher, because I had an expectation that volatility would rise, and then able to capture, then kind of buy back in after we had that volatility event. But yeah, my first instance is to have risk management, use it as a risk management tool rather than a way to profit from the rise in volatility. But that's definitely a possibility, but it's not a tool I have.
Okay, and let me ask you, with what's happening now in VIX, even though volatility has come in dramatically in a few weeks, it seems to me that I don't think we're going to see 10 for a while again. Do you think we've entered a new regime? You showed some charts from past events. I think the 2007 level, normal volatility levels before the crash were more like between 15 and 20. So do you think that we're going to have higher volatility levels no matter what the direction is of the market, and the days of 9 and 10 readings might be over for quite some time?
I think probably so. I think a big part of it has to do with what the Fed's doing. Being that big of a player in the market, they're going to leave a big footprint. So when you've had all these years of, and we've still been able to have volatility with the Fed doing QE, but as they exit the market, and now we have kind of that artificial put being taken out, that it now allows the market, I think, to have much more volatility, because you now have a buyer that's left the market. And while they weren't buying equities, that still has an impact on the equity market. So I think now that you have the Fed unwinding, you have some more international banks discussing unwinding or at least slowing down some of their buying programs. I think that creates the catalyst to where we could have some more volatility. I don't think we're at the point where we're going to start going into a recessionary type period or anything like that, but I think it's definitely, their thumb's kind of been taken off the scale that's going to allow volatility events to be more prevalent. Okay,
and as a certified market technician, the fact that we held the 200-day on most of the indexes during that panic and have retraced, I don't know, 78.6. Do you think there's going to be a retest before we see new highs, or that was it?
Yeah, so I wrote on my blog last week kind of what my expectations were, and said, okay, we've held the 200-day moving average. That was obviously the softball entry point there, with everyone pretty much was watching that. So that almost became a self-fulfilling type prophecy. Typically, when you have markets that then rebound, you'll see it will retrace about half of the decline, which that would have taken us back to about the 50-day moving average, which we did. We did see some supply re-enter the market around that level. Well, we had a couple-day consolidation at the 50-day, right around, it was like, what, 2,700. And then we've now moved higher. The fact that we didn't see a retrace after hitting the 50% makes me think that we'll probably my expectation is that we'll see new highs before we see a retest. We didn't have the divergences, we didn't have the weakness going into the downturn to make me think that it was going to be a much more protracted decline. And so typically the anything over 10%, you're going to see a lack of participation at that high. Whereas this decline was more sentiment-based. It was, you had too many people on one side of the teeter-totter, and that teeter-totter had to be kind of reset. Well, we had a 10% correction, kind of shook out some of the hands and reset the market. And now it seems like we are seeing kind of more risk on trading again. Technology is doing well, financials are doing well. The higher beta portions of the market, growth stocks are doing well, have all kind of come back. We're not seeing institutions starting to sell, trying to sell this rally. It seems like they're more like buying this rally, which makes me think that's probably going to be more sustainable than some people believe.
Great interview, Andrew. I want to thank you so much for your time and wish you continued success with your RIA and your writings, and
Thank you very much.
Like it or not, Andrew, you're now my trading warrior brother, and
I'm glad to be included.
Yeah, and I learned some things about volatility. What's the best way besides your Twitter handle at Andrew Thrasher for people to follow you and possibly
yeah, my blog is probably the best place. Yeah, athrasher.com is where I put out a lot longer term than what you can fit into a tweet. So athrasher.com is where I put all my commentary.
Okay. Well, thanks again, Andrew. I'm glad I reached out and invited you. Maybe we could get back together some months down the line and see what things are setting up for you. Maybe 3,200 S&P. We could talk again.
Sounds good.
Thank you very much, Andrew Thrasher. You can follow him at Andrew Thrasher or go to his website. And volatility is a very important ingredient of what we do, and you can learn and educate and be aware. So that's a wrap up for us today, everybody. See everyone tomorrow. Good hunting the rest of the day. See you in the private chat, and above all, don't just count your pips, count your blessings. See everyone for investing.com Thursday. See you guys tomorrow. Adios. You're very welcome, Bob. You're welcome, Kareem. And thank you again, Andrew.